Welcome to the Deep Dive. We're here to give you the shortcut to being well-informed.
Today, we're going a bit deeper.
Yeah, we really are. We're tearing down some of the conventional wisdom around immigrant finance in the U.S.
Right.
So we're not just talking about simple budgeting tips. We're diving into the real structural barriers.
The unexpected data, too.
Exactly. And the massive market opportunities that are just, sitting there when people try to build a life here.
And this is such a critical topic.
Yeah.
Because at its core, we're talking about financial inclusion.
Which is really foundational for just financial well-being for anyone.
Absolutely. Inclusion is sort of a three-part system. You need access to basic bank accounts, for one.
Okay.
Then you need access to the credit reporting system. And critically, access to affordable short-term credit. For millions of newcomers, the U.S. system just throws up these immediate huge roadblocks.
And they're very specific roadblocks, aren't they? It's things like having no U.S. credit history at all.
It just doesn't transfer over.
Right. Language barriers, documentation challenges. It makes the established system almost impossible to navigate.
It's a system designed for Social Security number holders. That's the bottom line. It creates this kind of shadow financial world for anyone without one.
So our mission for you today is to really uncover how newcomers can build a strong financial foundation and do it quickly.
And how to avoid those predatory debt traps.
Yes. And ultimately, move from being credit invisible to actually building real generational wealth. So we have to start at the very beginning. Step one, getting a bank account.
The lack of basic banking access it's the first crisis point.
Right.
The data shows it again and again. Latino households, for example, are way more likely to be unbanked or underbanked.
And if you don't have a bank account, you can't really function in the modern economy.
You can't. So where do you go?
You go to the alternatives.
You're funneled into these incredibly expensive non-bank products. We're talking about check cashing services.
Which take a huge cut.
A huge cut. Or buying expensive money orders just to pay your rent. These things just erode your wealth. They can take, 5, even 10% of a family's income in fees alone.
So how do you get past that first wall? It sounds like the key is actually the humble debit card.
It is the absolute entry point. For a newcomer, a bank just requires far less documentation to open a checking account and get a debit card.
Less than for a credit card, for sure.
Way less. A lot of community banks and credit unions will even accept an ITIN, that's an individual taxpayer identification number, or other forms of ID instead of an SSN. It's the simplest way to get into the digital system.
And it's not just about access, right? The debit card actually encourages smarter behavior from the jump, which is so important when your money is already stretched thin.
We call it the budget buddy. And for a good reason. It's financially defensive by nature.
Because you can only spend on what you have.
Exactly. It's linked directly to the money in your checking account, so you can't accidentally rack up debt like you can with a credit card.
Plus, it's just so much safer than carrying around wads of cash, which is what so many people are forced to do.
Oh, absolutely. So once you have that account, the defensive strategy really begins. The budget has to be, super realistic.
You have your must-pays, rent, groceries.
But for newcomers, you often have other things.
Yep.
The high cost of visa applications, for instance, and remittances. That's a huge one.
Sending money back home to family. For a lot of people, that's not optional. It's a fixed cost, sometimes even before they think about their own savings.
It's a non-negotiable bill. And that reality makes the standard advice of save 3 to 6 months of living costs really, really hard to do at first.
So the top priority has to be avoiding that high-cost debt.
It has to be. Because if you can't get into a traditional bank, you end up at a payday lender, and suddenly you're looking at triple-digit interest rates.
So the advice here is to really seek out the ethical options, the specialized places.
Always. Look for mission-driven institutions. CDFIs, community banks, credit unions. They often have products designed specifically for immigrant communities, and they offer much fairer terms.
And on those international money transfers, the remittances, I assume transparency is everything.
It's vital. You have to use reputable services that are upfront about their fees and exchange rates. Informal channels might seem cheaper, but the risk is just too high.
Yeah.
That emergency fund, even if you start small, is what keeps one unexpected bill from pushing you deep into debt.
So establishing that bank account, practicing defensive budgeting, that creates a stable foundation.
Right.
But to really get ahead for better jobs, lower insurance, a home, you need credit. Which brings us to our next section, the credit invisible crisis. This is where the scale of the exclusion is just Mind-blowing.
The numbers here, they should be alarming to everyone. The
Yeah.
CFPB data shows that roughly 20% of the U.S. population can't even be scored by the traditional credit system.
20%. That's what
Okay.
the population of California and New York put together,
Yeah.
just locked out.
Yeah. It is massive. And within that, you have 26 million people who are credit invisible. That means they have zero credit file. None.
Wow.
And then another 19 million who are unscorable because their history is too thin or it's too old.
And as we said, immigrants are a huge part of this group because if you had perfect credit in, say, Mexico or India, it counts for absolutely nothing here.
It's like it never happened.
Yeah.
You are starting from a complete blank slate no matter how responsible you were before. And that lack of history costs you money every single day.
And higher rates for everything.
Everything. Cell phone contracts, car insurance, you name it.
Okay, so once that bank account is set up, how do you go from invisible to visible? What are the pathways?
Well, there are three common ones, especially for younger people or newcomers: credit cards, student loans, and something called piggybacking.
Let's talk about piggybacking. It sounds a little strange, but it's a really important shortcut.
It is. It just means you get added as an authorized user on someone else's credit card,
Someone you trust.
a friend or family member who has a long, positive credit history. And here's the key. You don't even have to use the card.
Ah.
You just benefit from their history of on-time payments and low balances being reported on your credit file.
That is a powerful tool, but it obviously requires a lot of trust. So if that's not on the table, you're building it on your own.
You are. And that's where the secured credit card comes in.
Right. We said the debit card is great for budgeting, but doesn't build credit.
Does zero for your credit history. So you need a product that reports borrowing. For a newcomer, an unsecured card is usually out of reach. So you start with a secured card.
And that's where you put down a deposit.
Exactly. You put down, say, $500 as a security deposit, and that $500 becomes your credit limit.
And the hurdle there is that $500 itself can be a lot of money to tie up for a family just starting out.
It's a real friction point, no question.
Yeah.
But using that card responsibly, small purchases, paying it off in full every single month, that's the behavior that quickly builds a credit profile.
And that eventually gets you to an unsecured card and much better interest rates.
That's the goal.
This whole challenge, this lack of traditional data, is pushing the industry to look for other solutions. So let's talk about alternative data. What is this stuff that's supposed to help the credit invisible?
Alternative data is basically any reliable financial history that the big credit bureaus don't normally look at.
Like what?
On-time payments for things like your rent, your utilities, your phone bill, even streaming services. The idea is that new technology can use this data to figure out if someone is creditworthy, even if they're currently unscorable.
Which makes perfect sense. I mean, if you've paid your rent on time for 5 years straight, that is a huge indicator of financial responsibility.
It absolutely is.
So expanding access based on that seems like a win-win. But I can also see where it raises some pretty big ethical questions.
It raises major policy questions. On one hand, yes, it could open up credit to millions of people, but on the other, you have to worry about algorithmic bias. If the alternative data like where someone lives or what services they use, if that accidentally correlates with race or ethnicity, you could end up just building new kinds of discrimination right into the lending models.
So we have to be really careful that we don't create new kinds of unfair risks.
Precisely.
Which moves us perfectly into our final section, the ultimate barrier to building wealth, homeownership. And specifically, the mess that is the ITIN mortgage market.
This part is so important because of the economic potential here. Projections show that Latino households are going to drive almost 70% of new homeownership gains in the U.S. through 2040.
70%.
So we're serious about the future of the housing market. We have to fix the barriers for people who use an ITIN to file their taxes.
So we're talking about people who are paying taxes, contributing to the economy, but they're locked out of the main lending system because they don't have an SSN. Just how small is this market right now?
It is shockingly tiny compared to the potential. In 2023, the estimates are only around 5,000 to 6,000 ITIN loans were made in the whole country.
That's it.
That's it. But the research suggests that if you remove the structural barriers, the potential market could be somewhere between 73,000 and 88,000 loans a year.
Wow. So the demand is there, but the supply is broken.
Completely broken.
And here's the fact that I think should just shatter all the old assumptions. How do these loans actually perform? Is all the perceived risk actually justified by the data?
No, it's the opposite.
Yeah.
Overwhelmingly, the people who actually make these loans, mostly credit unions and CDFIs, they report that ITIN loans perform just as well as, and often better than loans made to SSN holders.
Better. Why is that? What's going on there?
Two main reasons come up all the time. First, a really strong aversion to debt. Many immigrant families just view debt very differently and prioritize repayment above almost everything else.
And the second.
Multiple wage earners in the household. It's very common. So if one person loses a job, there's an immediate buffer. There are still 2 or 3 other adults contributing to that mortgage payment.
So they are low-risk, high-performing borrowers, but they get hit with these punitive terms. That makes no sense.
It's totally punitive. Lenders pass their own risk onto the borrower. An ITN loan typically demands a down payment of 10 to 20%.
Compared to what, 3.5% for an FHA loan?
Exactly. And the interest rates are higher too, often 50 to 200 basis points higher than a comparable traditional mortgage. You're paying a penalty for being excluded.
Which brings us to the core problem, the liquidity lock. Why can't a big bank just start making these great loans and selling them?
Because of the secondary market. This is where it gets technical, but it's crucial. The vast majority of mortgages in the U.S. are bought and insured by Fannie Mae and Freddie Mac, or the FHA.
Big government-sponsored players.
Right. And their rules require borrowers to prove legal U.S. residency or have an SSN for them to buy or insure the loan.
So a small community lender makes a high-performing loan to an ITIN holder, but they can't sell it to the biggest buyers in the market because of a rule.
That's the liquidity lock. The lender is forced to keep that loan on its own books in its portfolio, and that ties up their capital, which severely limits how many other loans they can make.
If they could sell it, they'd get that capital back immediately.
And they could go out and make dozens more loans.
Yeah.
The market would it would explode overnight.
So the solution here is really about policy, not about the performance of the borrowers. What changes could unlock this?
The first and biggest would be administrative changes at Fannie and Freddie. Just removing the legal presence requirement and creating clear, standard rules for these loans, that alone would pump liquidity into the system.
And what else?
Second, policymakers could mandate that state down payment assistance programs, which almost always require an SSN, have to be available to qualified ITIN holders too. That would help them clear that huge 10 to 20% down payment hurdle.
Okay, so we've covered 3 huge pillars today. First, just getting into the system with basic banking and defensive budgeting.
Yeah.
Second, overcoming that silent crisis of credit invisibility. And finally, this massive bottleneck and, frankly, massive opportunity in the ITN mortgage market.
And if you synthesize all that, the path forward is really a two-way street. It takes responsible habits from the consumer budgeting, avoiding bad debt, saving, but that has to be met with systemic change.
We need to use that alternative data for credit, and we have to get rid of these arbitrary market barriers.
Exactly.
And I think that leaves us with a final thought for you to chew on. Considering that ITN borrowers who face higher costs, fewer options, and structural exclusion have proven to be exceptionally good at repaying their loans. What does that high performance really tell us about the millions of other credit invisibles still locked out of the system?
Maybe the real risk isn't in the people at all.
Maybe the risk isn't a financial system that's just using the wrong tools to measure them.